So you're saying that rather than managing inflation and growth, one of their targets is to keep a lid on the stock market. I find that quite extraordinary, Ed.
Yeah, I wouldn't go that far. I wouldn't say that's one of their targets. Their target at the moment is very clearly looking at the speeches, keeping a lid on inflationary dynamics. But to keep that lid or that pressure down on inflationary dynamics, we need tighter financial conditions. Now, financial conditions are the cost of debt primarily, as well as things like credit spreads, but also the equity market. And I think what the Fed was telling us in August, as it was talking back up interest rate expectations, was that financial conditions were too loose, that equity markets had got this wrong. And that means that whilst the Fed, I think, would be perfectly happy for equity markets to rise a bit from here, in the near term, if we saw another 10, 20% on equity markets, I think the Fed might have something to say about that.
Can I ask you why you're cautious on cash versus bonds at this point? I mean, we've travelled a long way on bond markets of late, but why are you cautious?
We're cautious at the moment because of a deteriorating macroeconomic backdrop and the fact that inflation, whilst we have a high conviction will fade next year, may not fade as rapidly as the market is currently pricing for. So, we're overweight things like cash. Look at the 6-month UK T-bill; it's yielding 3%. There is now an alternative, to use that phrase. We're starting to prefer credit over equities. We like quality within equity markets and parts of the market with a structural story.